because everyone's out to practice and being in a live event, so you've forgotten what it's like to talk to people. But I suppose that's one of the big things this morning. It's great to see so many of you here. This is our first live Macroeconomic survey launch event we've done for 2 years. We've done them on Zoom in the last couple of years, but this is the first time we've come back to doing them in person. What a time to do this over the last couple of years. We've obviously had a real range of challenges and issues that businesses have got to deal with. And it feels sometimes that you just get over one, and then another one quickly comes along, and then another one, and then another one. So how many spinning plates people are juggling at the moment in time could vary from business to business, but it's an awful lot, and there's no two ways about it. It is having a big impact on business. How much of an impact? We'll find out today as we go through our first QES presentation of the year. My name is Chris Fletcher, I'm the Policy Director at the Chamber. In a minute I'll hand over to our expert, Subrah, who will take you through the results of this quarter's QES. For those of you that haven't been to one before, and maybe for those of you that have been to a presentation before, I think it's important to just remind ourselves why the QES, the Macroeconomic Survey, is so important. And there's a series of things on the screen there that just show, why the QES is important. It's the largest, most reliable business confidence survey. Then that business confidence bit is becoming even more important. Yes, the numbers matter, obviously, but that element of business confidence is really important. Sample size, yes, it does matter. The more responses we get from businesses like yourselves, direct from the front line, it makes it more accurate and more reliable when we're trying to see what's going to come ahead. So important at present, and also to look at what's happened in the past as well, because while it's important to know what's down the road, you sometimes got to see what's happened in the past as well, because sometimes that just helps decide and make more clear about what's happened. Does first week matter? Does being first matter even? Yeah, it does, because what we try and do is to get this information out as quickly as possible. We don't sit on it for 6 months, or sometimes government data is years out of date. We get this direct from the business community and we turn it around very, very quickly. And it's not exactly real time, but it's as near to real time as you're ever going to get for a survey like this. So we're not talking about something that's happened last year, 12 months ago, whatever it is. This is what's happened in the last few weeks, last few months. That's so important. The policymakers use the QES, yes they do, and that's again very important. When we're talking to MPs, the Mayor's Office, whoever it is, they want to know what's happening in the local economy here in Greater Manchester. Feed that up through British Chamber of Commerce into that national picture as well. So, what we're going to talk about at this point, I will hand over to Subrah and the clicker across. Subrah will take you through the rest of the presentation. Thank you once again for coming this morning.
Thank you very much, Chris. Good morning, everyone. It's a pleasure to see you all here and actually do this in person. Because I'm doing this in person, please ignore the subtitles. On a good day, it doesn't like my accent anyway. But with me sort of standing so far apart, it probably is going to say something rude. So just you ignore it completely. Anyway, so what are we going to look into today? I'll just quickly summarize the results of the quarterly economic survey. We have the Greater Manchester Index, and then the component parts of the Greater Manchester Index, which is domestic demand, international demand, business investment, confidence, the standard macroeconomic indicators, plus of course importantly labour market and recruitment difficulties that many businesses have reported they are facing at the moment. Now you may know that we have been working with the Greater Manchester Learning Provider Network, which is an association of all of the independent learning providers. And together we have been doing a series of surveys and other research called GMBEST, stands for Business Employment Skills and Training. I'll very quickly refer to those results. I'm not going to have any slides on that because that's an extensive dashboard of information which is available on our website to access for everyone. So some of you may be wondering, what is the Greater Manchester Index? Now the Greater Manchester Index is a combination of 7 different QES measures, and it is a composite economic indicator. So that's your key takeaway for today. It is one number that gives you a snapshot in time. So it's an indicator of where the Greater Manchester economy is at this point in time. And those 7 measures that make up the Greater Manchester Index are domestic sales, domestic orders, export sales, export orders, confidence in turnover, confidence in profitability, and finally capacity utilization. And as you can see, all of those are very important macroeconomic indicators. So we combine those 7 measures into the Greater Manchester Index. And actually, the interesting thing is that the Greater Manchester Index shows a very strong correlation with UK GDP growth. And so whenever UK GDP growth has gone down, we have actually seen the Greater Manchester Index go down, but 3 months in advance, which is the predictive value of the QES. Because we are looking at the results now, so when you get the information out in 6 weeks or 12 weeks' time from the Office for National Statistics about where the UK economy is, the QES actually gives you a little bit of a preview. Obviously, we are looking at Greater Manchester, but because Greater Manchester's economy is so important, you get a kind of a mirror view of the UK economy as well. So that's the Greater Manchester Index. So what are the headline findings for this quarter? The Greater Manchester Index was at 32.3. And to put it into perspective, during the peak of the COVID crisis, it was at minus 32. So it was exactly in the opposite direction. So almost a 200% increase at the moment. But it has been pretty much at that level for 4 quarters now. So since the second quarter of 2021, we have been at around 31, 32. And that means there is a sort of flattening, a plateauing in economic activity. There isn't a significant improvement since the bounce back from COVID. And the interesting thing, of course, last year was that we saw huge percentages of growth. We also saw the Greater Manchester Index go up from minus 32 to minus 6, and then minus 6 to plus 30. That bounce back was actually because of the low base effect that we had in 2020. We had such a shrinking of the economy, 10% of GDP, probably 14% shrinking of the Greater Manchester economy. And so compared to that, we were in a very good position. But for the last 3 or 4 quarters, the Greater Manchester Index has been flat. It has been at that 32 level. And so what makes up that 32.3 level? Its domestic demand has shown a marginal improvement in all sectors in this quarter. And when you see the slides, you understand this, the results are broken down by 3 sector groups. We combine all of the services sectors into 1 sector group. We have manufacturing and production, and then we have construction standing on its own. And we presented that because we have a sample size to break the results down by sector. Construction is a very important sector for Greater Manchester. Just look at the number of cranes around us. You get a view of how important it is at this moment in time. So domestic demand has gone up slightly in this quarter, but that has been offset by a slight reduction in international demand. And what we saw with international trade activity was that it went up in the 4th quarter of last year, probably because of shipping pressures, easing or supply chain disruption easing slightly towards the festive season, but it has now kind of balanced itself. So international activity has shown a slight quarterly decline. Demand has actually significantly improved since the COVID pandemic. The main concern for many businesses seems to be cash flow positions. And cash flow positions have not recovered anywhere near demand levels now. And so cash flow positions remain squeezed. That obviously has got implications for the ability and the intention to invest, particularly in capital projects. You know, that heavy capital expenditure, that's probably not going to take place immediately because cash flow pressures are still squeezed. And we look into all of these separately. But the good news, of course, on the labor market front is that employment prospects are up. And 83% of those businesses who have responded and said that they are actually trying to recruit or have recruited in this quarter are recruiting for full-time positions. And that's a very healthy number. 83% of the businesses recruiting for full-time positions is actually really healthy. But the downside of strong recruitment is that we have recruitment difficulties, but we also have wage inflation. On recruitment difficulties, there has been a slight quarterly easing. But I think that's probably, again, recruitment activity that takes place towards the festive season, but then we have the Omicron restrictions imposed, and so there might have been a slight tail off with recruitment in the beginning of this quarter, but again, that's going to pick up, no doubt. And we have actually looked into wage inflation, so I'll present those slides separately. But again, many of you as business leaders will understand that wage inflation is an issue that you're grappling with at this moment. And as I said, business investment has improved in this quarter, and actually there has been a slight improvement relative to, say, 2020 and or even the beginning of 2021. But the key concern is that business investment is still way below pre-pandemic levels. And in fact, it declined in the last year. In 2021, business investment went down. That's relative to 2020, so you can imagine the extent of the problem. But the hope is that measures such as the super deduction, the increase in the investment allowance, etc., will probably make an effect, and it will probably have a positive impact. That's the hope. But let's look into business investment and all of these other measures separately. So just, this is the macroeconomic context. The macroeconomic context that we are operating under is that growth in the fourth quarter of 2021 was only 1%. It was actually expected to be much higher, but it ended up being 1%. Obviously, we had Omicron towards the end of that quarter. We expect, this is our forecast, we expect first quarter growth in 2022 to be roughly 0.7%. Business investment declined. And why am I kind of harping on business investment, and many of you have attended my previous presentations, is because in 2021, a lot of the growth that we had, in my view, is because of consumer spending. It's you and I spending our money. It's money that we couldn't spend in 2020, with hospitality shock, retail shock, etc. So pent-up savings, pent-up demand, etc., all being realized in 2021. Now we know that there are headwinds for consumer spending. Consumer spending always tails off after the festive season. So that's one factor. The second factor is the cost of living prices and high inflation. So household budgets are being allocated for, let's say, energy, fuel, etc., so that there is less disposable income or less to spend on retail or hospitality. So I expect consumer spending to actually decline, or at least soften a little bit. And what that means is, unless we have business investment to pick up and offset that reduction in consumer spending, the growth prospects will remain muted, and which is why business investment extremely important. And so, the single most important ask of the Chancellor of the Spring Statement was do something, obviously to ease the cost of living crisis, but the second most important thing from a business point of view was take measures to unlock business investment. And unless we can unlock business investment, further growth prospects in 2022 and beyond are always going to be muted, because consumer spending will definitely tail off in this year. So in the fourth quarter of 2021, services output increased by 1.2%. Manufacturing was pretty much flat. Manufacturing has been flat for more than 2 quarters now. Construction grew by 1%. Now these growth figures, you have to bear in mind, are also influenced by inflation. So we have higher inflation rates, so obviously growth is going to be slightly elevated because the current price issue comes into the picture there. And in February, retail sales volume actually decreased relative to January. In January, they were slightly better than they were in December, because we had Omicron disruption in December. So in January, it was high. But again, online retail seems to be still going very strong. Online retail was 37% of overall retail sales last year. In February and March 2021, 37.7% of overall retail sales was taking place through the online channel. That has decreased now to about 28 to 29%, but it's still a huge portion. The 5-year average between 2016 and 2020 was about 18%. So you can just imagine the impact that COVID has had on the high street, the adverse impact, and then the positive impact on online sales. It's just a massive change now. Okay, and so as you can see in this slide, the Greater Manchester Index sort of correlates with UK GDP. It has been flat, so since the second quarter of 2020, it has been relatively flat. It has been at the 31 to 32 level. And we need significant business investment for it to improve further. So let's get into the component parts. And from this slide on, the data is split by sectors, and that gives you a very good sectoral view of the economy. So when it comes to domestic sales, it's made up of 2 measures. Domestic demand is made up of two measures, I beg your pardon, domestic sales and domestic orders. On both those, there has been a slight quarterly improvement, and that's true for all of those sectors there. There's a slight decline, just a marginal decline in manufacturing, but it stays well within the marginal error. So overall, domestic demand has actually relatively stable. Stable. I think there is still some consumer spending. There's a lot of money that is being directed towards energy, fuel, etc. All of that gets accumulated within the services sector. Production is down. We know that, and that's probably why manufacturing has had a kind of more adverse impact relative to the other sectors. Retail sales is again stable. There has been a decline in February, but the good news is 3.7% up retail sales relative to February 2020. Again, influenced by inflation, no doubt, but it is good news in any case. So that's on domestic sales. The slightly contrasting picture on domestic orders is actually good news, because you see a very healthy increase in all three sectors. And so the theory is, if order books are good and they stay good, then there is a very good chance that businesses will be able to secure business investment, increase capacity utilization, etc. I don't want to build a big narrative around one quarter's results though, but the hope is that orders and order books will stay relatively strong. Again, you will have experience of this, no doubt, in your businesses, so any feedback is obviously welcome. So that's on domestic sales and domestic orders. There has been a quarterly improvement, and order books are looking reasonably healthy at the moment. And this is the same data that is broken down by sub-regional geography. So I have split the data by the three GM regions. GM North, which is Wigan, Bolton-Bury, Golden Rochelle. South is Salford, Trafford, Stockport, and Tameside. And then Manchester sits on its own. And that's how it is presented in ONS data as well. Again, it's a relatively similar performance. We see GM North has actually had a slight downturn this quarter. Again, very, very marginal. But do remember, there is a high concentration of manufacturing businesses, logistics businesses, etc. in GM North. And we saw domestic demand in the slide. Manufacturing has had a slight downturn. That's clearly reflected in the place-based geography as well. And this is why the QES is actually really interesting, because it gives you information not just on sectors, but also the relative performance of different regions. And if I had 1,200 responses every quarter, I would probably split the results by individual local authorities within GM. But that's up to you to help me do. So, GM Central, which is that black line there, has been flat. Again, services is relatively stable. We have seen a slight downturn in consumer spending, on retail sales. And that's where it goes. Your spend on hospitality and retail gets bulk of it goes towards Manchester. There is this trend towards go local and eat local, etc. It was a big thing during the pandemic when travel was okay. But is that sustainable in the long term? I'm not so sure. Because ultimately people want to come to Manchester, because that's where the key attractions are. But it's not. I mean, that's not to say the local offer isn't great, but the local offer is always going to have to compete with Manchester. And better the transport links during the weekend, more people come to Manchester. Okay. And then on the order books issue, which is domestic orders, again, we saw the improvement in all three sectors, and we've seen that improvement in all three sub-regions as well. So that's what correlates and confirms the picture. Okay, on export sales, we have a reasonably good handle on export sales because my colleagues in the international trade team handle export documentation, they handle customs declarations, etc. And I'll invite my colleague Amy to comment on these results in a moment. But what we have seen is a slight quarterly dip in international trade activity. I think that's the result probably of that sort of peak in the last quarter of 2021. So towards the end of the last year, probably in the lead up to the festive season, we saw that increase in international trade activity. That could be the result of supply chain restrictions easing, as I said earlier, because we know that those have been actually serious barriers to businesses being able to trade. So on both export sales and export orders for the two sector groups, there has been a slight decline in this current quarter. Amy, any comments on that?
Yeah, I think from our side we've seen the documentation stats are still lagging behind where we'd expect them to be now, and that's seen across the whole chamber network. We're still seeing freight costs affecting international orders, so a lot of people are now, consolidating goods. They've moved them into the EU before Christmas, and then they're distributing them from warehouses there. We obviously see the Ukraine-Russia side of things, so companies that have Russian origin products now are now not able to export those into the EU because of the sanctions. And a lot of feedback from our freight agents is saying that the warehouses are actually full in Eastern Europe, so in terms of goods getting in, well, the warehouses are full, so there's difficulties there. I think in one scenario, just to put it into perspective for freight costs, this is on an import we did, the £6,000 part, the freight was £20,000 from China, so it's 4 times the value of the part. So they're live examples we're seeing, and I think companies as well in terms of exporting have tried it last year. They're hit with Brexit surcharges, duty bills going to the wrong company, they want to pay it. So that's all the feedback we're getting. We're saying until we can make it easy, we're trying to help them through that, and they're stopping exports, which is obviously not great. So do all we can at the minute, but still there's Brexit. We've got the introduction of more rules this year, so particularly animal origin, animal byproducts. There's some more gradual rules coming in throughout the next 6 months, which are probably going to impact export as well.
Thank you, Amy. So let's get to the other measures now on cash flow positions, and this is kind of the number one concern that I have about the QA's results and have had for some time now. Because as you can see, those domestic demand numbers, those international numbers, were sort of in the mid-20s. International was again just about 20 in this quarter, but look at cash flow positions, they're still around 10. And cash flow positions have never really recovered since the pandemic, and I think that is probably because of enhanced investment that has actually gone into making adjustments for COVID, and then having to readjust, and now it is probably the consequence of kind of higher energy prices, high fuel prices, etc. So the main concern with cash flow is that because we have seen cash flow balances to be relatively flat, and there has been that marginal quarterly decline as well, the outlook for investment remains constrained. Come 1st of April, we have increase in national living wage, national minimum wage. So obviously that's going to put some pressure on cash flow. The 1.25 percentage points increase in national insurance contributions, that's going to increase the cost of employment. And of course, all of the additional expenses that comes with higher inflation. Higher input materials cost, higher shipping costs, as Amy was pointing out now. All of that is going to put further pressure on cash flow. And this is something we've been saying for quite some time, that unless we get cash flow pressures improving as a result of much enhanced demand, we're not going to see a positive impact on business investment. So cash flow pressure positions for all 3 sectors are slightly declined in this quarter. And the capacity utilization figures are sort of similar. And again, capacity utilization did go up since the pandemic, of course it did. And since the beginning of 2020, we've actually seen it increase. But we used to see capacity utilization in manufacturing, in services at 60%, 70%. And in construction, we have seen capacity utilization close to 90%, which in itself is not quite healthy because you don't have much room for expansion. But that's how busy businesses were. That's how strong order books were. Capacity utilization is that high. But now it is in sort of 30s, 40s. Construction obviously is a bit volatile relative to the other sectors. So it is still quite strong in construction. It's about 70% capacity utilization. But for the other 2 sectors, it stays well below 50%. So that's 50% operational capacity being utilized at the moment across the economy. So you can imagine how much spare capacity there is for servicing for the orders, servicing for the customers, etc. So again, once cash flow positions improve, demand improves further, we will see capacity utilization actually pick up. But since then, that's probably going to stay flat. So, business confidence, and obviously this is a very important slide. There are 2 questions that we ask about business confidence. One is, how optimistic are you, business leaders, about being able to maintain your revenue or your turnover? And the second question is, how confident are you about being able to maintain profit margins? And both of those are important. The first is an indicator of capacity utilization, investment, etc. And the second is a good indicator for not just profit margins, but also how prices are moving in one point in time, both input prices and the prices at which you sell your own goods and services. So on the first one, turnover confidence. Turnover confidence was, the proportion of businesses who are saying that confidence has improved, which is what is represented by those green bars, was sort of in the 60s towards the beginning of 2021. It declined slightly, it's gone back up to 62.5%. So the most recent data set, 62.5% of businesses have said that turnover confidence has improved, that it has increased. There has been a proportionate decrease in the red area, which is the businesses amongst you saying that actually you are less optimistic or pessimistic, in fact, about being able to maintain revenues. So that's on turnover confidence. And then when it comes to profitability, you see that difference. While 62.5% of you have said that you're able to maintain your turnover, just about half you're saying that you're actually able to maintain profit margins. And we know profit margins are being squeezed by enhanced prices, by wage inflation, but also because demand is still, there is good demand, but demand hasn't increased significantly so that we can start charging much higher prices. Now, you look around and you see much higher prices being charged everywhere. But across the economy, I don't think profit margins are still very high. So we're seeing huge turnover, but not necessarily proportionate profit margins. Again, this is a good indicator. This is a forward-looking indicator in the sense that this is what you hope will happen in the next few months. It's relatively stable, so I'm not saying this is bad news. But again, these balances we have seen 75%, 80% of the respondents saying that they are able to maintain revenue. So relative to that, it is slightly lower. But for the last 5 quarters, it has been pretty much around that 60% mark. So that's reasonably stable on both turnover confidence and profitability confidence. Okay, and then investment. So we have seen that cash flow pressures are affecting businesses. We have seen capacity utilization staying relatively flat, so there is room already with existing capacity. And business confidence has remained relatively stable. Is it any surprise that business investment has not increased significantly across the economy? Because when cash flow pressures are weak, are strong, then you don't see a significant increase in business investment. So the 3 sectors actually present a very contrasting picture. Again, construction tends to be volatile, so I'll leave construction aside for a moment. But when we look at the manufacturing sector, there is good investment. Investment actually has gone up. And I think this is the result of businesses being able to take advantage of the super deduction. So any investment that we make now obviously qualifies for that 130%. That obviously has got a good impact on manufacturing. Now, the initial announcement that was made by the Chancellor last year was that if you invest in digital technologies, you're not eligible for the super deduction. So it was a very traditional definition of capital investment in that you buy plant and machinery, you expand factory capacity, etc. But that is then advantageous only for some sectors, not necessarily for the whole of the economy. They have slightly tweaked that definition, so now there are some deductions available for digital investment as well. However, we haven't seen that huge pickup in the service sector. So it's a manufacturing sector which seems to be taking advantage of that investment opportunity on capital projects. Service sector, still below 10. So that's not that, and that it has been below 10 for quite some time, since the pandemic actually. So again, unless we see that enhancement in capacity utilization, cash flow, etc., we're probably not going to see a huge increase in business investment. And that problem is going to affect growth prospects. Because we see consumer spending decline, business investment not necessarily picking up, growth prospects will remain muted. And then the other important issue, of course, is investment in training and skills development. Of course, we hear about labor shortages, we hear about wage inflation, and so when I speak to learning providers, the immediate question is, well, why aren't businesses investing in training? And the response is often businesses aren't probably they don't have the cash flow positions, etc. So this is an issue that we have actually researched in detail in GM Best. And you can look up the results on our website. Interestingly, the number one barrier for uptake in training is not necessarily the cost of the training program itself, it's the ability to release staff time to actually go and take up training. So many businesses say, well, we can't release 3 or 4 members of staff or 3 or 4 days of training. That actually is going to have an adverse impact on the business. So that has actually come up as a very interesting issue. And traditionally, the view was that, well, we have to give free training courses. And actually, well, free training courses will certainly help, or funding for training will certainly help. But it's not just funding issue, it's the business ability to actually release staff time. But having said that, there has been a slight quarterly increase in investment in training. But again, like with capital investment, this is one of those measures that has stayed relatively flat. So we haven't seen that huge upturn in investment in training. But there are some big changes coming in the skills picture with local skills improvement plans and so on, which the Chamber will be working on. And the aim is to sort of, get lots of investment in upskilling, lots of investment in reskilling, etc., which will then alleviate some of the labor shortages that increase. Okay, so staying with that labor market theme, recruitment prospects and recruitment difficulties. And this is a story of our times. Whenever the economy is doing okay, whenever there is growth, we see more and more businesses trying to recruit, and we see an immediate increase in the proportion of businesses who say you're facing difficulties recruiting the right candidates. Right? And that's been a trend for quite some time. So I've done something which is slightly different. What I've done is to break down the recruitment activity by the type of role. So just to illustrate what it is that businesses, what type of role is it that businesses are recruiting for. And obviously you will have a much better handle on this. So the absolute indicator is that more than 80% of you are recruiting for full-time positions. And that's really good news. Because it's not part-time, it's not necessarily the temporary jobs. And you can see the temporary jobs are the least in favor. So, unlike some of the media coverage about what businesses do, actually, recruitment is for full-time permanent roles rather than temporary or then the zero contracts. I'm not saying that those are not used, but it is primarily full-time positions that are being recruited for. And then we also have recruitment for part-time positions, temporary positions, etc. But when it comes to recruitment difficulties, okay, there has been a slight quarterly easing, but let's just look at the previous quarter for a moment. In December 2021, more than 80%, close to 90% of construction businesses said they were having difficulties recruiting. More than 80% of manufacturing businesses said they were having difficulties recruiting, and with services it was about 60%. You see that slight quarterly decline, but we also see that slight quarterly decline in recruitment activity. I think this is probably a combination of businesses kind of reopening after Omicron, the end of the festive season, because we always see kind of temporary employment go up during the festive season, and then there's a slight reduction immediately after. That's what is playing into this. But for even during the recovery from the pandemic, the media coverage confirms this, but we know that recruitment difficulties have been a very serious concern for many businesses. And this is true for all sectors. People were talking about chefs, truck drivers, but it's not limited to those roles. It's just across the board in all types of businesses, in all sectors. There are some serious recruitment difficulties. So the slight quarterly decline, that is great news. But overall, businesses are facing recruitment difficulties at the moment. And so what are the implications of recruitment difficulties? And we wanted to look very clearly into both wage inflation and the proportion of businesses paying the real living wage. So let me just kind of dissect the slide a little bit. So the question that we asked for this slide and this slide was, there are wage increases. Many businesses are actually having to up pay packets. So what is the percentage of pay rises that have been offered? So for Greater Manchester as a whole, it seems to be close to 8%. So across Greater Manchester, across all sectors, the increase in pay seems to be just about 8%. Now there is actually a little bit of detail in here, which is that there is a separate question which we have published as part of the Greater Manchester Best results. There seems to be a slight difference between pay rises for existing staff and what I think was trying to call it the new starter inflation. In other words, when we are trying to recruit now, obviously the pay that has to be offered to attract good talent is much higher. That is not to say existing staff do not get pay rises, but that seems to be much higher, the proportion of pay rises to new starters. That's actually well over 10% now. Probably in some specialist roles, there were a couple of businesses who said they have been actually forced to offer pay rises of between 30 and 40%. And that's for some specialist engineering roles. So that's how difficult the market is at this time from a recruiter's point of view. So across the board, it is about 8%, but then, in most local authorities, there is some pay rises happening. Certainly in Bolton, it is close to 10%. Salford, leading the pack with about 11% along the Thames side. There were a good number of don't know responses to this question. So it might be that this picture isn't complete yet, but we can keep polling and then collecting good data about this. But there are pay rises taking place. Absolutely no doubt about that. So that's on average increase in pay rises broken down by local authority. Well, when we present the same data by sector, you don't get a kind of a largely dissimilar figure in any case. So for construction, it is close to 8%, for manufacturing just about 6%, and then for services just about 8%. Okay. So there are some pay rises taking place even when we look at it from a sectoral point of view. But here's the interesting thing. CPI is currently 6.2%. We expect it to increase to 7%. So when the data comes out for February, March, etc., we expect it will be 7%. And there are some economists who expect it will peak at close to 8% or 8.2%. So there is a very good possibility that inflation might outpace wage growth. We don't know that, but there is a possibility that inflation might outpace wage growth. If that happens, you can imagine what happens to consumer spending. So we're going back to that kind of vicious cycle of consumer spending tail off and growth prospects being muted. But the good news, of course, is that it's an employees market, it's a buyer's, it's a seller's market rather than a buyer's market at the moment from the employees' point of view. So there are some really good wage raises taking place. It's across the board, and obviously when we look at specialist roles rather than sectors, that's where we get the good intelligence. And then the other thing that we wanted to find out was, again, there's some criticism, isn't there, that businesses don't pay the real living wage. They pay actually just about national minimum wage, national living wage, etc., or actually, in fact, pay lower in some sectors. So we wanted to find out what's the data about that. There is some data which is available from the Office for National Statistics, and that shows comprehensively more than 3/4 of employees in Greater Manchester get paid the real living wage, not the national minimum wage, not the national living wage, but the real living wage or higher. So that's £9.90 or higher. More than 3/4. And of course, there is a difference with local authority. That data is not available by sector; it's available by local authority. In some local authorities, it's well above 80% of the employees getting the real living wage. So that's looking at it from the employee's point of view, because that's based on payee returns. But we wanted to find out what proportion of businesses pay all of their workers £9.90 or more. So on gathering intelligence on that. And across Greater Manchester, confirming that data from Office for National Statistics, more than 3/4 pay the real living wage. Now, are they accredited by the Real Living Wage Foundation? No. Probably 10% of the businesses are, or probably less, I should think, are accredited. And when we're kind of researching this on the Real Living Wage Foundation's website, they list just about 320 businesses for Manchester, not Greater Manchester, for Manchester, that cannot be right in terms of so the point is we cannot use a real living wage foundation accreditation as the sole benchmark to determine whether businesses are paying the real living wage or not. Okay? Picture is much more complicated than that. This real living wage foundation accreditation includes kind of audit of the supply chain. There's quite a few steps in that process, but we were the first chamber actually to get real living wage accreditation. But 3/4 or more of businesses in Greater Manchester pay the real living wage. Some small differences, but I just want to point out there are a good number of don't know responses, because it may be that people who are responding to the survey may not necessarily understand the picture of the whole organization. But this is some really good intelligence here, and it's kind of flying the flag for the business community, because the data needs to show what the policy makers are actually telling us. And actually, sometimes the data that we gather contradicts what they are telling us. This is a good example of that. Okay, and then finally, inflation, which is sort of the elephant in the room that we can't ignore. Inflation as a concern for businesses. 80% of construction businesses are concerned about inflation. No surprise there, because lots of raw materials get imported. So you then have that problem of not just the material cost, but also the shipping cost, which affects. And the same applies to the manufacturing sector to a good extent as well. So anything that is imported now is going to go up in price. And that affects food, clothing, but also raw materials that goes into the production process. And even in the case of services, more than half service sector businesses amongst you are really concerned about inflation. And this is hardly surprising considering energy prices, fuel prices, wage inflation, etc. But of course, what constitutes the number one worry for inflation is different in different sectors. And so in the manufacturing and construction sectors, of course, it is raw material prices. You can see that it was as high as 90%, but it's still well below 80%, and it stayed at about 80%. So 80% of manufacturing business is concerned about raw material prices. And when it comes to services, okay, it's just about 30. But when it comes to other overheads, that's what service sector is particularly concerned about. So it's more than 50% of service sector businesses actually say that it's overheads which is the main concern. And this was something that came up because with business rates, there was a holiday, and then obviously some service sector businesses have started repaying business rates. Now with a discount available for some sectors, particularly retail and hospitality, but this is something that is going to get thrown into the mix and put further pressure on cash flow and so on. Okay. So inflation is a really serious worry at the moment. Okay, and then finally, the summary. So the main outcome from the latest few years is that there is a stabilization, there is a plateauing in most economic indicators. Inflation is the main worry, and it is projected to outpace wage growth, according to some economists. We have an enhanced NI contributions starting next month. That's going to increase the cost of employment, no doubt. Even that increase in the threshold, if you no doubt seen the breakdown. So that threshold increase from 9.5 to 12.5 is going to actually have some impact. If one earns about 34,000 or so, then you will see a net reduction in your mixed contributions. But if you earn 34,000 or more, then actually you will see an increase in the mixed contributions despite that increase in the threshold. But remember, it's 1.25 percentage points, which means we'll all be paying 11 or 12.5% more in national insurance contributions. It's 1.25 percentage points. So it's not a 1.25 percentage increase, it's a 1.25 percentage point increase, which is actually quite sensible. The estimate was that increased national insurance contributions will net 12 billion to the Treasury, of which they have used just about 5.8 billion for the reduction in tax revenues as a result of the enhanced threshold. So the Chancellor is still going to keep 6.2 billion from the next year. So it's actually quite a sizable enhancement. Business investment has not rebounded, and that remains constrained by cash flow pressures. We need sustained business growth. And then our forecast for 2022 is 3.6%. We have downgraded that from 5% to 3.6% to reflect the deterioration in consumer spending. Just finish with saying one thing. If you look into the GDP numbers, obviously you get a headline GDP, but then you get an increase in growth in each and every sector. The one sector that stood out in the last 4 or 5 months is health and social care. So it's still health and social care spending, NHS track and trace, etc., which is contributing to a significant increase in service sector activity. The second was professional services, including IT services. But health is the #1 contributor for increase in GDP. So once NHS track and trace is kind of being wound down, isn't it, from the 1st of April, we're going to see that impact GDP numbers as well. And that's taking into account inflation and the fact that it was a bounce back from that low base. So we need to see a serious increase in business investment for real growth in the economy. And that's the key takeaway, I think, on small businesses. With that, I'll hand over back to Chris.
Thanks very much, Subrah. I think we'll just give a quick round of applause for another. Anybody got any questions? Anything you've heard either this morning or elsewhere? I've got a couple more, I'm just curious.
I'm just curious about what you think the impacts will be on manufacturing in the future, particularly in this region.
From
in terms of what's happening, do you see?
Manufacturing, so again, there were a few things that were being said during the COVID, and one was about this nearshoring or onshoring, wasn't it? That we would actually be importing less and we would be producing more here. Unfortunately, that's not going to happen. And, I'm sorry to prick any bubbles that there are. We are not going to become a manufacturing-based economy. It's just not going to happen. There can be certain interventions during certain times to meet short-term requirements. Medicines, face masks, medical equipment, etc. That is what was happening here. Again, you might see some sectors like defense. That's something that's happening currently with the UK supplying lots of ammunition to Ukraine. There's going to be a slight increase in activity. That's not necessarily Greater Manchester centric, but that's the UK context. Because our wages are way too high. And then you compare with China. That's not a bad thing. But we can't produce goods at the price that China does, or Bangladesh does, or Pakistan does. Even India has become uncompetitive now. The procurement for textiles, for example, is completely deserted in India. It's all based in Bangladesh, Sri Lanka, Pakistan, because wages there are much lower than they are in India. So manufacturing is not going to return to the UK in every way. However, what are the advantages that we can play to? The advantages are we can play on the R&D related to manufacturing. So the additive manufacturing, 3D printing, advanced materials, coating of chemicals to improve efficiency. Those are the types of things that we can actually focus on. So it's kind of innovation-based manufacturing rather than mass manufacturing that I think we should be focusing on. And for that, there's certainly a future in GM and in the UK.
Absolutely. And just on that point, at the last Engineering and Manufacturing Forum, it was a great presentation. What's happening at the Graphene Institute in concreting. Just absolutely unbelievable. It was something that's literally a mile and a half up there. Absolutely world leading and completely revolutionised construction from all manner of things. So it is that bit of it that we do stand in good stead for the future. One of the things that we mentioned in business investments, and absolutely something that's been consistent right the way through this. Obviously, a couple of months ago, we had just a couple of weeks ago, things take time. We have the government's levelling up white paper finally come out, and another headline news today is about the economy's levelling off rather than levelling up, as we've seen. Is there a problem, though, that lack of business investment? The government won't actually say, well, we can't invest in local economies. And that boost that you could get from that's going to go missing as well, because the government's counting the pennies to repay its debts.
is there a real problem here that we've got a real structural lack of money going into key things?
Absolutely, and you know, I'll take the manufacturing example. So if we look into the local industrial strategy for Greater Manchester, there were 4 sectors which were priorities, of which one was advanced manufacturing, but the other was health innovation. But if we look into the allocation of money for health innovation, a lot of it still goes to Cambridge. That's why we have many, many pharmaceutical companies, biotech companies, etc., that can get spun out of Cambridge University. It's the best in research there is, but Manchester University is not far behind. But the inequality in the amount of money that is allocated to different parts of the country is actually quite stark. So when it comes to health innovation, it goes to, lots goes to Cambridge. We've got a huge number of businesses there, just coming out of the university and the ecosystem that the university has managed to develop. Now, we expect something similar could happen with advanced manufacturing here in Manchester, so the Henry Royce Institute, etc., that kind of funding. But you're right. You know, if we look into the just the numbers, there's 12 billion that is projected for the Treasury to come from national insurance contributions. The Treasury is only going to give away 5.8 billion with that increase in the national insurance. Progressive measure as it is, it's still 6.2 billion that the Treasury is going to retain. There was a headroom for just over 24 billion for any additional spending or for additional support to both individuals and businesses. That was going to happen because obviously inflation is going to push up interest rates. So it is certainly going to have an impact on money that is allocated from the public purse. We're still not clear about what the replacement to some of the EU funding schemes, so EU Horizon 2020 and so on. So the answer seems to be shared prosperity fund. But the shared prosperity fund was obviously mentioned in passing in the level of white paper. We still don't know what money is going to come and how the money is going to come to reach this. So government can use investment, public investment, to spur private investment, and that's something that we shouldn't take the balls off. But with the current pressures in the Treasury, I think there is going to be a slight reduction in public spending on innovation, R&D, etc.
Okay. So I thought it was interesting that there was limited, if any, reference to the climate crisis, because I know that's a big topic for at the moment. So is the government, is it on their agenda at the moment? Of course, it was only less than 6 months ago we had the COP gathering. So is that on anybody's agenda? Was that referenced in anybody's comments or feedback in there in the survey?
No, we didn't ask any questions. We obviously asked those questions in the third quarter of 2021, and at that time, overwhelmingly, it came out that the energy utilization, and then its adverse impact on climate change, business practices, etc. All of that is really high on business agenda. There is absolutely no doubt about that. It has been kind of the discussion around climate crisis peaked around COP26 and sort of gone down now, but actually it needs to come back into the agenda. Even if it is not for the kind of the ecological reasons, for a monetary reason, which is that if we can generate more and more of our electricity here, through solar, offshore, wind, even nuclear, then actually we're going to reduce a significant amount of reliance on oil generally, fossil fuels. It saves a huge amount of money, because I remember oil prices from $40, $50 all the way up to 120, 125, 110 now currently. That's gone down slightly. But we are exposing ourselves to volatility and sudden increase, sudden decrease in prices because we have a huge reliance on fossil fuels. So the more energy we can generate here, that obviously is much better for the climate if we are using renewable sources, and it also reduces our reliance on oil generally, not least oil from Russia, but from every other place.
I think one of the issues with that is how quickly you can make that conversion, and that's the problem, because the problem is people have been sat in their hands for too long with a lot of that, and now, when obviously the prices going up through a variety of reasons, it's not like just flicking a switch. You've got to have that long feeding time to make that conversion. So
You'd think if the business investment was going to come from anywhere, it'd be on a road to net zero.
I think net zero and digital are the two main opportunities.
I think it's amazing, isn't it, the historic times that we're living through at the moment. And a presentation like this, which is fabulous, by the way, as a non-economist, I understood it, so thank you. To not even mention Brexit, because we talked about the pandemic and COVID and 2 years influence that side of it. But where do you think we are now? We made, sorry, the mistake of coming at you, but this will introduce us. 2 years down the road, our GDP figures, are they getting back to what the government sort of suggested we were going to be at, or are we miles away from there, or if we can not consider the COVID influence?
Well, the government's own modelling said there was going to be long-term scarring from the combined effect of COVID and Brexit, so they have sort of negated what the PR spin is. Secondly, exports are 16% down. Obviously, COVID has had an impact, but Brexit has had a huge impact because of the shipments, the difficulty in shipments. There was a slide that the questions that I didn't necessarily present the results for. So since December, actually the first quarter of 2021, there has been a question that has been included in the QES about what are the difficulties, resultant difficulties from Brexit, and we've asked it in 3 terms: movement of people, movement of goods, and movement of services. And even now, 30–40% of the respondents say it is extremely difficult to move goods and services. I think 70% of businesses have been consistently saying do not know for movement of people, because obviously we haven't started moving people yet. Right? So Brexit is going to have an impact. It has already had an impact. And it's the combined effect. The problem with 2021 and probably to an extent 2022 is it's extremely difficult, if not virtually impossible, to delineate the impact of COVID from the impact of Brexit. And that has actually enabled some split.
And of course, the latest one is, of course, it's all very much in war's fault. That's a horrible thing to say. We can see it happening, and people are using these tragic events as sort of, sort of scapegoat to put things on. We have this conversation all the time. We've had for the last 2 years. How on earth do you desegregate what's COVID, what's Brexit, and what the other things as well? And it's somewhere in that mess there. So some figures, I can't remember who produced them earlier this week, but we're comparing ourselves to other countries that are still in the EU, but bounced back after COVID from the level of exports. All the other countries, you can see the lines going up. We were sort of bubbling along the bottom, like a person that got left behind. It's difficult to do that. Just got time for one more question. Sorry.
Oh God, I'll try and make a good one.
Absolutely, no pressure.
You touched on recruitment difficulties. Are you able to just give us a bit more of an insight into what those difficulties are? Is it primarily that businesses don't have the cash to offer very competitive salaries, or is it Brexit? Or I'm an employment lawyer, so I'm just intrigued. I'm not in business myself, but I just want to know, why people are struggling, and if you see any obvious sort of answers to that problem.
I don't know whether there's one answer to that problem. I think it's probably a combination of a few different things. There is this dashboard about Greater Manchester Best, which if you actually leave me your email address, I can send you. But we've asked this question, broken down into, actually, that one question broken down into 3 separate segments. When we ask, about what types of roles is it that businesses are facing recruitment, it's technical and skilled roles. So it's those skills, the practical skills, whether it is in manufacturing, construction, etc. That's not new. It has been like that for quite some time. The second reason, obviously, is of historic underinvestment in training. And that's not just a business issue, but look at the amount of churn that has been in just skills provision in FE in the last 10 years. So when the Lib Dem Conservative coalition came to power, they said we want businesses to take ownership of the skills system. Businesses said we don't want ownership of the skills system. We want to influence the skills system. We want the skills system to respond to our requirements and actually provide the training that we have to offer. But we don't want to own it. So that was that. And then that was changed. And then there was the employer ownership of skills pilots, which actually Greater Manchester Chamber did at that time. And then the policy changed again. So it became a kind of a more centrist approach with kind of Westminster going to decide. Policy changed again because the government said actually you're going to all have local industrial strategies and then you have consequent skills plans from the local industrial strategy. But in 2021 they ripped apart most of the local industrial strategies, and the local industrial strategy council, industrial strategy commission or something, that was actually disbanded in 2021. So there have been so many policy flip-flops with this. And that has left businesses not being able to recruit, a deficit in kind of skills, no clear guidance or funding for actually upskilling and reskilling activities, no support for soft skills, for example, because that's something that came up in our research, the importance of soft skills. And I'll give you another example of this. The Chamber was a Kickstart gateway, and was it 1,200 or 2,000 placements that we advertised, and 1,000 placements actually started. We had a drop-off of something like 25%, if I'm not mistaken. But the number one reason for the drop-off was this candidate did not turn up in time. This candidate did not even turn up on their first day. The candidate came on the first day, left at lunchtime, did not come back again. So it's that kind of, I don't know whether it is a combination of work ethic or it's what I kind of bundle within emotional intelligence, soft skills, etc. It's that which is a big barrier. So is that something that needs to start at school, perhaps? So there is no one answer to why we are facing recruitment difficulties. But when we ask employees, obviously some employees will say, well, it's competitive salaries. But on the other hand, from the business point of view, it could be a combination of issues such as can't get the right talent, can't get the right talent for specialist roles, etc. But yes, it is also true that businesses have to spend more on training. And I think policy needs to kind of support business uptake of training.
Okay, I'm certainly something we're looking at in more detail as we go forward as well. What skills improvement plans that were announced in the level of white paper as they come to fruition and to make sure we can start to tackle some of those problems. I've been doing this job nearly 20 years now. It's always been a problem. So before that as well, but we need to get to that position now to say, right, this is what that means. This is what we do with that issue as we begin to tackle this. That's all. Anyway, time's come. We're going to draw today's event to a close. Thank you so much for attending, and again, thank you, Subrah, for making it so clear what is actually going on. We're going to record this, or we have, not going to record it, we have recorded it. We're not doing it yet. If we record this, hopefully we'll be able to get that out on the website. Please have a look at it. If we can share the GM Best web address with everyone in the room. It's a fantastic piece of work. So we said with the GM Learning Provider Network, it drills into some really fascinating data, both by sector and also by area as well, about some of those recruitment issues that we've got. Thank you so much once again. It's absolutely fantastic to be back in the room, as it were, with everyone. Thoroughly enjoyed it. Enjoy the rest of your day.